Keep an eye on that credit card. Yeah, prepare for interest rates to rise again this week as the Federal Reserve again tries to lower inflation. It's up to 8.3% this past year. The Fed is expected to raise rates another 75 basis points as they did in June and again in July. Well, higher rates mean it costs more for you to borrow money for everything from mortgages to car loans, credit cards. Evan Sowers of St. Louis's Central Bank joins us, and just to discuss in general what the Fed plans to do, and will it make a difference? 75 basis points, or will they go for a full percentage point? What do you think?
Well, if they raise it another 75 basis points later this week, that'll be the third time in a row, and we've never seen that before. So kind of a historic event either way. Obviously, last year when borrowing costs were low, we had a red-hot stock market, red-hot economy, unemployment super low, and that lower interest rate, lower borrowing cost is great for growth companies. They could fuel new projects, new things like that. But obviously, we didn't want to overheat the economy, so they started cranking up the interest rate. So you see that kind of retreat. They got to do it delicately, though, because they don't want to throw us into a full-blown recession.
Do you fault the Fed for not acting soon enough?
There's a lot of debate about that.
Yeah.
I don't envy their position. They got to be really careful on how they do it. And it's a very kind of a fine tweaking here or there. I know they had to do something. When and how much. I think that's kind of debatable. But I think they're very cautious and measured on how they're increasing the rates.
How long do you think they'll continue to do this into next year?
Well,
Do you have a crystal ball?
I don't know.
Yeah.
Unfortunately, I wish I did.
Yeah.
I think they're going to wait and see. So they've adjusted a little bit, kind of take a little pause, a little rest, check the numbers, adjust it a little bit more. This, I don't know, is there going to be another one after this? I think they're going to kind of wait and see what the inflation numbers do.
Yeah. People really notice this, when you're shopping, but also those looking for mortgages.
Right.
Let's see, it's doubled from 2.9% a year ago to 5.89% as of September 8th. So I was kind of adding up some numbers. If about $135 more per month compared to last year, would that be right with your payments? That's
right. Yeah. So as you know, the 30-year mortgage tracks the 10-year bond very closely, and today that 10-year bond's like 3.44%. A year ago it was like 1.37%. So almost, more than double. And you've seen that in the interest rates on mortgage and borrowing. So the payments have definitely gone up, especially on floating rate debt.
We have people from all different incomes watching. What advice would you have? Do you have any general advice during a period like this?
Great question. Yeah, at Central, we're having a lot of conversations, being proactive, talking to our clients and just saying, hey, are you comfortable with, seeing the stock market decline? It's off 15% since the beginning of the year, the Dow, at least. What does your overall balance sheet look like? Do you have a lot of shorter term debt at a higher rate? Maybe there's still some things that we can do. So there's a lot of things that we're definitely trying to be proactive and talk to our clients and figure out where their pain points might be and how we can help.
Evan Sowers, thanks so much for joining us from St. Louis Central Bank. You know Timmy Zell.
Yeah, of course.
Tim doesn't know much about the economy, but he knows a good thing when he finds it.
Okay.
And he's got a hot commodity for you this morning.
Can't wait to hear about it.
Little tip, here he is.